Okay, folks, it is 1:01, so I think we will get started. Some people are still joining us, excuse me, from the lobby. So welcome. My name is Ian Campbell. I'm the Vice President of Operations at PACICC, and I'm the staff lead for the Risk Officers Forum, and I'm also your host for today and a presenter as well. It's going to be an interesting day. So welcome, everyone. We have, I think, 50-something companies joining us from across Canada. Welcome, and if it's your first time on the broadcast, being part of this, special welcome. So this is our final Emerging Risks webinar of the year. And I want to thank a call out to Danica Hall, Manager of Operations, my colleague, who's working behind the scenes to help ensure a smooth broadcast today. I want you to relax and enjoy the next 90 minutes of discussion. And if I could ask to advance to the next slide, our agenda. So we are operating on the MS Teams platform that everybody in the COVID world is an old hand at this now. You're a pro knowing how to raise a question or raise an issue. You're going to use the little hand sign and under the reactions tab up on the top. And then we want this to be a very interactive broadcast. We want your questions and your comments throughout. So certainly encourage you to use that. Antitrust compliance is in effect throughout the meeting. The Compliance Act is in effect. We have 170 member companies approximately. Very interesting situation that we all come together to talk about industry issues, but it's not done. Everyone is coming together as competitors, and that remains in place. The session is being recorded. A copy of this broadcast is going to be placed on our website for future rebroadcast, and you're going to get a slide deck tomorrow. All members will be sent a copy of the slide deck, so no issues about that. With the panel presentation, in a minute, I'll be introducing the panelists. They're all PACICC staffers. So this, I think in sports parlance, this would be called calling your own number. But I'm very excited to be profiling a couple of my colleagues here on this report. I'll be talking as we close the broadcast about the final Risk Officers Forum meeting of the year taking place on November 16th. You will get a copy of the registration package tomorrow, and I'll let you know at the end of this broadcast who the speakers are for that event. And finally, we're going to close with a satisfaction survey. We want your feedback on today. Let us know what you like, what you don't like, topics and speakers for future. We are convening our Risk Management Advisory Committee on December 1, planning out the program of activities for 3 emerging risks webinars and 3 forum meetings in 2023. So we certainly want your ideas on speakers and topics. So I'm going to take a second right now and throw it over to our President and CEO, Alistair Campbell. He's going to give a few words of welcome and then pass it on to me, and I will introduce your panel of speakers. So over to you, Alistair.
Thank you, Ian, and good morning, good afternoon to all those who joined us. I think in my remarks previously, I've sometimes compared to the role of the CEO at PACICC to being the Maytag repairman. And for folks of a certain generation, that gag works because it correctly kind of parallels the repairman for a high quality product who never gets any phone calls. And in PACICC's experience, our little team is ready and all dressed up, and the phone hasn't rung in 20 years. And so honestly, when we have a dialogue with the industry, part of the question that must be forming in all of your minds is really how relevant is PACICC? Do we need it? Do we still need it? Do we need to keep paying for it? Do we need to pay more to make it more robust? Because honestly, Canada's insurance company quality is so high that the repair folks don't get called. And so it's a fair question. And so it's kind of familiar if you think about it from an insurance consumer perspective. Why do so many Canadians not buy the insurance they should for flood or quake? Why do people not necessarily insure to full value? And it's because, as a normal human instinct, we're all pretty sure that bad things can happen, but they will happen to other people and not to ourselves. And so as a Canadian insurance industry, it's easy enough to fall into that kind of normal human instinct that in a world of well-managed insurers, well-supervised insurers, well-capitalized insurers, under effective enterprise risk management frameworks with rigorous actuarial review and accurate accounting standards, it's just highly unlikely, if not impossible, for an insurance company in the developed world to fail. And if you just look at Canada, that would be a logical conclusion. And so what we thought would be useful as our research project for 2022 was to have our team dig into 4 very recent failures in developed economies that have taken place and each one of them graphically illustrates a kind of failure that is very relevant, because it's not impossible to imagine any of those scenarios unfolding in Canada. So I am going to throw it back to the team to walk you through these 4. But one last point to make. When insurance companies fail historically in Canada, they've failed in slow motion. You can see the accident happening as in advance. Chronic poor risk selection, embedded inaccuracy in pricing, chronic inability to estimate properly for claims reserves or estimation of liabilities. And as a result, chronic underwriting losses for sustained periods of time. And so you can see that happening. And then there's all these odd behaviors of raising new capital or spikes in growth so that cash flow underwriting can cover up the core flaws in the business, and then eventually over the cliff they go. And you can see in several of the cases we're about to present that that's exactly what happens. But in the last case, the case of Merced Insurance in California, there's a new and very significant threat. And I would say the short form version of the story is simply that increased climate risk is increasing solvency risk. Because you can have regional insurers with aggregation of exposure that's beyond what they understood and far beyond what they've modeled when certain types of event happen, especially types of event that are hard to model, and especially types of event that we are seeing more and more of as the climate changes. And so the case of Merced exposes a new risk for our industry to think about, for supervisors to think about. And it also poses some tests for PACICC, because our model has been designed to solve the other cases that are historically familiar. But we have claims limits that could prove highly problematic in a case of a natural catastrophe triggered default, where there would be a disproportionate number of large losses in excess of our defined benefit limits, with consequent issues for consumers and for the reputation of the industry. So I want you to keep all of that in mind as you listen to our researchers who have dug deep and then produced, I think, fantastic Reader's Digest précis of 4 fascinating case studies. So at that point, thanks for your patience. And Ian, I'll throw it back to you.
Thank you, Alistair. And if I could have the slide with the panel discussion. So I'd like to introduce my colleagues, and you're going to turn your videos on. Judy Peng is joining us from Waterloo. She is a research associate and PhD in finance, and she's done the heavy lifting on the background research for all the case studies here that you're going to see. So I certainly appreciate that. And she's recovering from a COVID booster on the weekend and looking great today. So I can only imagine it was a rough weekend. Grant Kelly is joining us from our regional office in Georgetown. Grant is our Vice President, Financial Analysis and Regulatory Affairs, and also our Chief Economist. And the job titles, PhD in Finance and Chief Economist. I think I'm out of my league in this broadcast, but we'll try to work our way through this. This is a study, the Mapping the Road to Ruin, the lessons learned from 4 recent insurance failures that we're going to be looking at. If things go really well, I'm going to point to Judy, and if things go off the rails, maybe I point to Grant, and it'll be all your fault. So that's probably a good rule of thumb for today. Okay, so research goals. Do we have that slide? Did we jump too far ahead? There we are. Nope. There we are. So PACICC has been doing this research series since '07, and we have certain goals four goals that we hope to accomplish through these ongoing studies. Increasing awareness. Insurance company failures can and do happen. There have been 32 in the period of time that PACICC has been in operation. It is a reality. Nobody likes it. It's not great for consumers, not great for the industry, but it's a sign of a healthy market that firms are entering and exiting the market, and we're just playing the hand dealt to us. We want to contribute to the literature on insurance failures. If you think of a traffic accident, we would be a first responder. So we see things firsthand, failures that have happened in the industry, and can read the tea leaves. We provide a unique perspective on explaining what happened and perhaps lessons for the future. We want to be a voice for consumers on insolvency issues. PACICC is an industry-funded organization, but we are consumer-focused. That there are expectations for the regulators have of us, that we are there on the side of consumers, that we are not an advocacy group for the industry. That's the Insurance Bureau of Canada, but we actually are here for consumers. And then finally, ensuring that PACICC remains relevant with policymakers and regulators, both in Canada and abroad. We want to demonstrate that there is a solid safety net here in Canada, well functioning. With the Risk Officers Forum, we provide insight and information. We also do that through information sharing, bringing together parties from the industry in exercises like this. This is all pointed at increasing solvency, strengthening solvency in the industry. And that's really good for consumers and certainly a positive point for PACICC. So a little history here about the past publications. These are all on our website. There are 16 different reports available. And you'll notice that over the next 2 pages, I've done them in red and blue. Red is actually a case study, and blue is analysis of the industry. So, and these are analyses of companies that have failed in the past, both here at home and abroad. So this year we're looking at 4 insurers that have failed over the last 4 years. And last year's paper was looking at PACICC's capacity to respond. Grant's going to probably touch on that later on. The tipping point paper and the need for a government backstop to prevent contagion in the industry as a result of a failure of a large organization. In 2020, we looked at Reliance Insurance Company. It had failed in 2001. It was a healthy Canadian branch. It was a solvent liquidation, which is rather interesting. But the parent organization in the States, that was a $4 billion insolvency, and it was the largest in U.S. history. So a very good summary of that is in that paper. In 2019, we looked at the case for expanding PACICC's resolution toolkit, that we don't want to be just involved in liquidations, that actually, if we can get on the scene early, there are alternatives to liquidation. And that paper talks about some of the tools that would be helpful to PACICC to resolve well before the accident happens. In 2018, this is the first time we looked abroad for one of our studies. We looked at HIH Insurance Limited, the impact of a large insurance company failure. And that was a whodunit of sorts, in that it was the second largest insurer in Australia. They had 200 plus subsidiaries spread across the world. And in June of 2000, the company had $2.8 billion in premiums and $900 million in assets. Yet in March of 2001, just 9 months later, they're found to have a shortfall of between $3.6 and $5.3 billion. So invite you to look at that report online. It's summarized over 88 pages it took to tell the story, but it's a very interesting story about how a large organization was brought to its knees. We looked in 2017 at exit strategies. Grant looked at how firms exit the market and the orderly transition that has taken place in Canada. 2016 was rather interesting. The FMRP, there was a study of that. This was not a failure. It was a company that came very, very close. They were on the brink of failure, but were able to rebound with some remedial measures. And there are some good lessons in there about proper management. And in 2015, Grant looked at the role of capital in weathering crises. Going back, the next slide talks about 2014, Canadian Miller's Mutual Insurance had a very long history. This is a company well established, 1878, and their operations came to an end in 2001. 2013, we looked at catastrophic risk, the role of natural disasters and catastrophes and the threats that they play in the industry. Markham General, in the 20 years ago, they had a shortfall of $20+ million, which was really problematic for the industry. The company lasted 2.5 years, and it was a total mess and very irritating for surviving companies in the industry that here in Canada that had to clean that up. In 2011, we looked at new entrants, determinants of survivability for new entrants in the market. In 2010, we looked at Advocate General Insurance Company, which was wound up in 1989. Inadequate pricing was our focus of study, pricing the promise of insurance. Back in 2009, it's a very unique product, and everyone knows this, that insurance is one of the very few products that is actually priced and put out to market before all the true costs are known. And then Mayplex was a firm that failed in 1995 after 40 years in operation, so a good history with that company, but it had failed. And finally, the initial paper looked at the dynamics of P&C insolvency and provided the first spade into the ground, the historical overview of the Canadian experience with respect to insolvency. One of our co-authors for that paper was Daryl Ledbetter. You'll recognize the name. Daryl is now Senior Director, Insurance and Pension Supervision with OSFI. So as Alistair had noted, this is a time, this year's study, and go to the next slide, please, is a chance for us to really take stock. These are the common causes of insurer failure over the years, and the first three are the traditional failures, and the fourth we're profiling today to close the broadcast. But we've been doing this for 16 years. We're pretty confident that the first three, they've shown up a lot, and I'll talk about that with other failures. But just we're on the cusp of this is uncertain territory now. The natural disasters can quickly cause companies to turn unprofitable. So poor internal operations, these are issues baked right into the DNA of the company. Poor underwriting, taking on bad risks, insufficient loss reserves, rapid growth into new markets, and I'll talk about that with the first case study. The improper diversification in the lines of business, and risky acquisitions and joint ventures. There are problems with corporate governance. That's also an internal operation control, and that is a problem with the first organization I'll talk about. Management oversight, bad investments, poor capital management, and reinsurance misuse and mismanagement are all determinants under internal operations. And then complex organizational structures. Sometimes you have organizations that are multiple entities spread across multiple subsidiaries spread across the world, and just the communication, internal communication and management is quite problematic. Transparency in large organizations, getting all the available information you need to know to make key decisions. Financial reporting in the home country and abroad can be an issue. It's an issue with some of the companies we'll talk about today. Cost control, capital management, and avoiding regulatory oversight, which sometimes is the problem of the regulator, and sometimes it's the problem of the company ducking the regulator. So sometimes there are gaps, and we do recognize that regulators are like any other business. Sometimes you're taking on new staff who may be unqualified, and maybe they're lacking the funds with relocation. We saw in the HIH case study that the regulator was moved. The home office was moved, and that led to a lot of turnover with staff and inadequate resources. And in any good organization, any good regulator outfit out there is healthy skepticism all the time. You have to trust but verify. So sometimes there are issues with lax supervision, and we don't want to point the finger at regulators, but sometimes it is an issue. And then Grant will talk about natural disasters, exposure aggregation, inadequate stress testing, and then just the litany of possible disasters that can strike: earthquake, floods, hurricanes, tornadoes, wildfire, landslides, severe storms, and storm surge. And as Alistair noted, the climate change, the fact that this is becoming a bigger and bigger risk to the industry. Okay, so we've done 20 years. It's been 20 years since the most recent failure in Canada, which was home insurance. Insurers can and do fail. It's much harder to do nowadays. There are improvements in both operations and governance on the company side. We have risk-based regulation with stronger capital requirements. Companies are very aware of ERM best practices. We do a biannual survey here at PACICC to spread the word to the industry, and we've certainly seen a narrowing in the gap between small firms and big firms in terms of their approaches to enterprise risk management. The enhanced statutory financial reporting. There are more stringent actuarial and accounting standards in place now. There have been technological advancements, better pricing and risk selection, which are helpful to companies, and greater transparency about risks, exposures, and claim development trends. And this is certainly helpful to companies. So it is harder for organizations to fail, but they do fail. And our examinations today, we're going to look at these 4 cases. So I'm going to look at Gefion Insurance AS, and that is a firm out of Denmark, failed in 2021. So the ink is still wet on that one. Judy is going to look at the next 2, CBL Insurance Limited in New Zealand, which failed in 2018, and Anbang Insurance Group Company Limited in China in 2020. And then Grant's going to close off with Merced Property and Casualty Insurance Company, failed in California in 2018, and he's also going to roll up the general observations, the key learnings from this exercise. We can't be complacent, essentially, is the message. That's why we're looking at this right now. It's been a long time since an insurance company has failed in Canada, but it's certainly possible. So the one now I'm going to look at is Gefion Insurance. It was established in Copenhagen in 2014 and was regulated by the Danish Financial Services Authority, the DFSA. The organization spread its business, primarily auto, across 7 countries in the EU: Denmark, the home country, France, Germany, Ireland, Italy, Poland, and the UK. And they did that under freedom of service provisions that allowed for free movement in the EU. Their focus was on small and medium-sized companies. And this is an organization that flamed out in 6 years. So very fast growth, very ambitious, but it quickly came to a close. So the next slide, the key financial ratios, you'll see that 2017 really was the turning year for this organization. 2017 was its best year. And there are gaps, you will note in the table here, that we were relying on public information, and we didn't have information on solvency ratios in 2018, and also the regulator stepped in, I'll talk about in a second, in 2018 and 2019 in 2019, but reflecting back to clean up its records, public records for 2018. So it had to recast and restate its figures. And it was essentially bad news from 2017 on for Gefion when the regulator stepped in. So DFSA launched an investigation. It came to the attention that the company was experiencing problems. So the 2017 was its best year. Its combined ratio was lowest in 2017, and its return on equity was highest. And you'll see that return on equity just basically fell off the face of the earth as we move through the next years, and also the combined ratio was increasing from that point on. So the gross expense ratio fell consistently throughout the period, and the loss ratio was increasing throughout the period. And in terms of DFSA, they launched a very in-depth investigation. That started in November of 2018. They were on site at the offices of Gefion, examining essential areas of business with a very risk-based assessment and approach. They looked at the business model of the organization, its outsourcing, technical provisions, its investment activity, solvency, its capital handling, its capital plan, the board of directors, and the management systems and controls in place. And they found numerous deficiencies. And then they were very quick to act on this. So this is not a case of regulatory oversight. This is a case of the regulator came on very, very strong. And I'm sure the Gefion management was scrambling all the time. So in terms of numerous deficiencies, they found that management and corporate governance were problematic. The control of external agents and claims managers was very problematic. Their solvency ratio, 86% in May of 2019. They lacked funds. The organization always was short of money. The loss ratio, the DFSA required them to recast 018 numbers using all relevant data, and that's why you saw that recast in the table. Reinsurance recoverables were found to be overstated. That didn't take into account counterparty defaults. The accounting receivables was not fully accounting for losses abroad. There were problems with the organization's ORSA, meeting capital requirements from proving that they had sufficient capital for the next year and throughout the plan period was a problem, as well as premium provisions. The use of homogeneous risk groups to rate some of their risks was a problem. So DFSA launched into them, and quite severely, starting in November 2018, and just a whole series of orders in terms of cleaning up shop that ultimately led to the demise of the organization. So immediately after the investigation began, there was an add-on capital requirement of 39.2 million Danish krones for the organization, which caused some issues with the table in terms of reporting their profitability. The calculating premium provisions using all available data was another requirement from DFSA for the organization. DFSA required them to recognize impairment losses and receivables and take better recognition of that. With respect to ORSA, the asset's ability to comply with solvency requirements, they had to step it up. And also, in terms of there was an order to have liquid assets of 5 million euros by December 2019 on hand, which was a problem for the organization, as well as preparing a recovery plan that could prove to the regulator that the organization was going to pull itself out of these straits within the next 6 months. They gave them a 6-month window for recovery before taking further action. In March 2020, the organization DFSA stepped in to tell Gefion to stop new business and basically manage what was on the books. And they revoked their license on June 24th, 2020. And very quickly, July 13th, 2020, they were placed into solvent liquidation. And in the period of time, they ultimately failed on June 7th, 2021. But what tipped them over from a solvent liquidation into actual formal bankruptcy was a German car rental case that was proceeding along. And they lost the case, and it was a settlement of $30 million, 30 million euros that was awarded to the organization, and Gefion was just short of money and couldn't comply, and that tipped them into insolvency. So in terms of causes of failure, corporate governance deficiencies, there was always a problem across these 7 jurisdictions it was operating in: the control of outsourced activities and ineffective compliance with regulators. And you saw that certainly in the home country, and I can only imagine abroad how one step removed they were in terms of regulatory oversight, that they were doing all of this and having all these problems under the oversight of DFSA. So it's one step removed and more problematic in the other 6 countries that they were operational in. Internal audit and risk management function were found to be deficient by DFSA. So the problems in terms of corporate governance are very similar to cases we looked at in the past. With respect to Mayplex, Markham General, and Reliance, these were key causes of their failure. And it was a contributing failure to Advocate, Canadian Millers, and HIH. A second cause of failure for the organization was just rapid growth across Europe. This was very similar to Mayplex, Advocate, Canadian Millers, and Reliance. Those are key issues that brought down those organizations, and a contributing factor for HIH, which built its business continent by continent and 200 plus organizations or subsidiaries across the world. Very problematic. Poor capital management. They were always short of money. It was insufficient to cover the basic solvency requirements of DFSA. And again, this is similar to Mayplex, Advocate, Markham General, Canadian Millers, and HIH. Those were key determinants in their failures. And finally, reinsurance mismanagement, that it was very simplified and improperly used, that Markham General had done the same, and to a lesser extent, but a contributing factor with Canadian Millers and HIH. And you'll see in this table very small here, what you see on your screen here, but in the report you'll find online, what we've done is just repeated this table throughout, and for every organization, you'll find that across the top. And if it's a primary reason for their failure, you'll find that with a P, and if it's a supporting reason, you'll find an S, and we've just shaded in the areas. So for this organization, you can see that those 4 causes listed on the left-hand side of your slide, those are reflected in the table. But that table is repeated throughout the case study, and we just thought we'd give you something uniform that you could just kind of tick all the boxes, and that is repeated. So lessons learned from the Geffian failure, and there are 4 here. Essentially, the importance of internal controls that they were sadly lacking, and this is a function of decentralized operations for this organization. You want to ensure accountability and a proper use of the company's assets and resources, but they spread themselves really thin. And that was a problem in terms of regulatory oversight and just a day-to-day problem with the organization. Careful entry into new markets and new lines of business. So be careful where you go. There's a very steep learning curve that Geffian ran into in terms of managing uncertainties and entering into unfamiliar markets, new lines. They lacked the experience in these new lines of business and new territories. So that was very problematic. Capital management, again, a problem for Geffian, a key determinant of its failure. Maintaining capital strength is critically important for any insurance organization. And it's like me telling you, don't run with scissors. So it's something you know, but something so obvious that the companies do fail because of these reasons. And then reinsurance arrangements. The defaults of counterparties weren't effectively factored into this. Geffian did not adjust its recoverables. So they were overstated and unrealistic and certainly exposed by the regulator. Reinsurance can be a legitimate and effective means to augment your capital base. It's not a solution to bad underwriting. So that is a problem that Geffian ran into. So that is, I think, just a quick summary of the Geffian experience. And what we're going to do is go through, and if there are any questions, certainly fire them away. But if not, we're going to everybody will go through their case studies and the lessons learned, and then maybe we can open it up to general discussion if people have questions or comments later on, or ideas about other organizations. We're always looking for the next case study. So if you have, we found some very timely ones on the last 4 years, but if you have others that you think fit the profile and would be of interest to other colleagues in the industry, we certainly want to hear about that. Next year's case study is going to look at an analysis of the industry, but we'd be looking at in 024 for a case study. And you really need to go to our website. I strongly encourage you to take a look. All of our publications are online under the the Risk Officers Forum tab. It's a great library of studies. And if you don't have a lot of time, I certainly understand why you don't want to read through 88 pages of HIH. But if you read the executive summaries, it's all there. And they tell some really amazing stories about some very diverse situations, some very interesting reasons for failure. And everything's new and different. We always try to do something we haven't done in the past. And that's why we pretty much exhausted all the situations in Canada that could be looked at, the sexy situations. And then we started to look abroad. And that's why we did Reliance. That's why we've done HIH, and that's why we're doing these 4 today. So I'm going to hand off to Judy now, and I'll be back later on. Thanks.
Thanks, Ian, for the introduction of Geffian in the Europe. And now we're moving our perspective from Europe to the Asian Pacific region. So the first case I'm going to talk about is the CBL Insurance Limited. It's a company that was established in New Zealand in 1973. And in 2012, the CBL Corporation was formed, and the CBL Insurance was the main operating company in that corporation. So overall, CBL Insurance focused on the construction and real estate insurance, especially some construction bonds. So in Australia, instead of paying the contractor the money, you always replace the cash payments to them by a construction bond. So that's what CBL Insurance was issuing. And started in 1990, CBL Insurance has some business operations in Europe as well, especially in France, UK, and also in Ireland. And over time, it expanded its insurance products to include rental and travel-related insurance and reinsurance, and some reinsurance business with the two main P&C insurer companies, Elite and Alpha, resulted some problems of their failures because they have reinsurance contracts with CBL. And over time, in October 13, 2005, sorry, the previous slide. Yeah. In 2015, AM Best uprated the CBL's rating from B++, which is good, to A-, which means excellent. So that was the peak year for the CBL Insurance. And the whole corporation, CBL Corporation, was able to get listing status in both the Australian Stock Exchange and also the New Zealand Exchange. So it obtained dual listing status that enabled the company to expand further. Next slide. And from this graph on the left-hand side, we can see that CBL, the CBL Corporation, adopted very complex corporate structure. So the main office, CBLC, is in New Zealand, and it also has holdings in the Asian and also in New Zealand and Australia, as well as in various other regions in the Asian Pacific region. And CBLI, the New Zealand insurer, is in the middle, and it's the main operating body in the whole corporation. And of course, because the main office is in New Zealand, the Reserve Bank of New Zealand functions as the home country regulator and the prudential regulator. But because it has other business across Europe and in some Asian countries, Reserve Bank of New Zealand is not able to observe all the business operations in other regions. And in fact, CBL's business operations in New Zealand only account for a very small percentage of the corporation's business activities, and most activities are offshore, that is away from New Zealand, and the company is largely offshore. Next slide. And this table provides you with the key financial ratios for CBL Insurance Limited from 2011 to 2016. We can see that the expense ratio and loss ratio and other financial indicators seemed to be very steady over the years. But in terms of the solvency ratio, which is the solvency capital requirement indicator in New Zealand, we can see that it stays above 100. That's because the regulatory requirements for the company is around 170. We can say that it has been below that requirement from 2013 to 2015. And in 2016, although the number is above 160, it was turned out to be largely exaggerated. According to the news report, that since 2013, there is a shortfall of the requirement capital, and the shortfall was estimated to be 86 million in 2016 and 100 around 100 from 2014 until 2017. So over years, there was severe under-reserving issue for the CBL insurance company. Next slide. And the real problem for the company happened in 2016. In that year, the corporation, CBL Corporation, acquired the Securities and Financial Solutions, a French-based insurers that offers builder's warranty. And it turned out to be that SFS itself has under-reserving problems. And that exposed also the company to reinsurers risks. And as a side evidence is that the New Zealand Certified Builders Association might have found problems with the CBL insurance early in 2016, because from that year, the New Zealand Certified Builders Association shifted its partner insurance company from CBL Insurance to Lloyd's of London. So that's a sign that the company is under is doing some dubious business and has some financial issues. But at that stage, the Reserve Bank of New Zealand did not take any action until in 2007. So in 2017, the European insurers, two European insurers that rely heavily on the reinsurance policy from CBLI, they had some under-reserving issues and was caught into investigation by their regulators. So the first one is called Elite, that is Gibraltar-based insurers. In July 2017, it was forced into a runoff. And the second one is Alpha Insurance in Denmark. It also was being investigated by the regulator and went bankrupt in May 2018. Okay. So based on this story, we can identify the key reasons of the failure of CBL insurance. First is poor underwriting. And of course, it does not have sufficient capital to ensure its continued business. And also, it does not do very well cost controls. We can say the number has remained high, which might cause some problem for a new company. The third problem is that corporate governance deficiencies. For a company that has branches and operations across the globe, it's very important to do an investigation, especially when you are acquiring a new company. And in this case, the French company SFS has caused the problem because CBL Insurance has to injected a lot of capital into that company. And also the second major issue is the organization structure. When a company adopts a complicated structure, we might not be able to tell much from its consolidated reports. It's better to investigate into the operation activities for each subsidiary. And the third problem is adequacy of regulatory oversight. We can tell that in this case, the local Builders Association, New Zealand Certified Builder Association, have some insider information about the company's operations, which is earlier than the timing that was identified by the New Zealand Reserve Bank. So again, for a company that has multinational operations, it's very important that it comply with the laws and regulations in each jurisdiction, and also understand the operation activities for each subsidiary. So that's the lesson learned from the CBL insurance. So what, as regulators and also a guarantee fund, what kind of suggestions we could give? First is to adopt a whole company approach that would take the company as a whole, but in the meanwhile, we have to identify the risk that each of the key subsidiaries face. And it's a very common practice for these corporations with a lot of subsidiaries to use double accounting, that it uses funds twice. It might borrow funds from the subsidiary, and subsidiary use that money to capitalize other insurance subsidiaries. And this is a practice that we will also see in the Anbang insurance, which I will introduce next. And the second is that we have to ensure that the insurer has enough capital to pay the claims, which is the most important indicator for the health running of an insurer. Next slide. And oversight. Regulators must be quick to respond. In this case, in the case of CBL insurance, the Reserve Bank of New Zealand was very late and a little bit tardy in giving the court order to the company. That actually caused some collateral damage to European insurers. And lastly, is about the capacity that the home country regulators should form some cooperations with other regulators in, like in the case of CBL, the New Zealand regulators should form some ties with the regulators in Europe, so that it can take a international perspective. So that's the lessons learned from the CBL insurance. And the third case is happening in China, Anbang Insurance Corporation. So this is also a case of massive failure, but maybe on a much larger scale than the CBL insurance. Anbang Insurance was established in 2004 as a pure property and casualty insurance. So to begin with, it does not have other line of business operations. And its leader is quite a legendary figure. He got to know the former top cadres in China through his third marriage. And also he formed very strong political ties with the proselytes, the so-called proselytes, which are the offsprings of former officials of high ranks in China. That gives him some insider information as well as the sources of capital to expand his business. So between 2006 and 2011, Anbang Insurance rapidly setting up different lines of in other insurance companies. For example, it expanded to the health line and formed a company called Harmony Health Insurance in 2006, and also it went to the life line of business, formed Anbang Life Insurance Limited in 2010, and also it has pension line of business, which formed Anbang Pension Corporation Limited in 2016. And beyond that, it also initiated a series of acquisitions across the globe. So on the right-hand side, we can see the series of acquisitions activities Anbang did from 2011 to 2017. We can see that the first one maybe is the most prominent one that Anbang has did. So the target company is called Chengdu Rural Commercial Bank. It was formerly owned by the state, the local asset management of the government. So Anbang acquired 35% of the bank's asset, and the bid value was 5.6 billion RMB, which is equivalent to 1 billion Canadian dollars. And also, Anbang has business activities in Canada. We can say that in the last line of the table, in 2016, Anbang acquired Retirement Concepts, which is a retirement home operated in British Columbia. So the acquisition completed in February 2017, right before Xiaohui Wu was taken away by the police for investigation. And the bid value was around 1 billion Canadian dollars. And the first acquisition with the bank enabled Anbang to become the top 10 insurers in China. And to start with, remember that in 2004, 7 years before the acquisition, Anbang was only a very, very small and local insurer, and its revenue, its gross premium written was only 1.5% of China's largest P&C insurers at that time. So over this 12-year period, Anbang was able to extend its business to banking, hotels, health insurance, and injected billions of monies and became even the Fortune 500 companies in 2007. But where does the money come from? The Anbang empire was actually based on financial fraud, and it used double accounting to expand its balance sheet. Next slide. So this is the indicators of Anbang's financial performance. The top panel shows the asset growth of Anbang. So the P&C line of insurance expanded very quickly. In 2011, it was 5,193 million RMB, but in 2016, you can see the numbers grow glaringly to 795,000. The slide did not change. The last slide, I think it changed, but I don't know why it got frozen. So we can see that its asset grows by more than 100-fold. Where does that money come from? The trick is that Anbang issued a wealth management product that promised very high interest rate. It's very much like a guaranteed certificate that you can see receive more than 4% for a 2-year deposit term. And if you choose 5-year term, you can get more than 5% of return for each year. But at that time, the other, I think, commercial banks in China offers a rate of around 2%. So Anbang promised at least 2 times higher of the returns than an average commercial bank in China. This is how it attracts a lot of buyers for its wealth management product. But the problem is that Anbang, although it can use the wealth management product to expand its asset, in a few years of time, it will have to pay a lot of interest and the principal. But apparently, Anbang's other line of business cannot earn so many profits. And we can see that in terms of the combined ratio, it is very low, which means its main business is not insurance, but other activities such as the wealth management products. If the regulators has read these numbers, some warning signs might shown as early as in the in 2015 and around 2016, because the numbers are too low to be convincing. Next slide. In terms of the causal failure in this example of Anbang, we can identify the rapid growth is one thing. It branches into too many new businesses that is unrelated to insurance. And also there's corporate governance deficiencies. One way to, one problem in the governance issue is that it has a lot of related party transactions to expand its asset and equity. And in fact, the number of shareholders for Anbang went up from as few as 5 to more than 60 in 5 years of time. So that is a apparent sign of rapid expansion and some governance issues. And of course, the last thing is fraud with related party transactions. And also the adequacy of regulatory oversight is another reason. In China, we don't have a database like we have in Canada or the US. So in Canada, we have an MSA database that we can check all the financial statements for all the insurers since 1989. And in the US, we have AM Best and SNL that we can check the recent history of all the insurance. But in China, there's no harmonized accounting standards for the insurance companies. So if you compare the financial statement of insurance company from this year to the previous year, you might notice that some items just mysteriously disappeared. So this is a clear sign of inadequate regulatory oversight. Next slide. Here are another summary of the lessons learned for Anbang's failure. The prudential regulator in China is called the China Banking and Insurance Regulatory Commission. So it regulates both the insurance and bank. Since it has too many regulatory tasks, it might not focus exclusively on the insurance industry. And it failed to harmonize the reporting criteria for all insurance, which if you want to analyze the insurance industry, you might find it's very difficult to give a cogent picture of all insurance because their financial reports, the items does not simply match. And for the wealth management product Anbang has used to expand its balance sheet, it has not a clear definition whether it should become a specific asset type and what kind of capital adequacy ratio we should apply to that product. And also the regulator seems not have reviewed the regulator, the insurers' activities very often, as we can see that the combined ratio is too low to be convincing. And also, Ambon has apparently internal control issues, that there's no clear picture of the business strategy, that what industry want to focus, and whether other businesses such as the hotel and pension houses would affect its operations. Next slide. And the third lesson is that when a large company enter into the new line of business, we have to carefully manage the uncertainties in the new market. For example, Ambon was involved in some lawsuit related to its hotel business in the US during the COVID pandemic. And because it has so many assets outside China, it's very difficult to oversee them in timely manner. And the last thing is about risk management. And the issue Ambon has is maturity matching. So its asset come from the wealth insurance product, and its liability has a combination of long-term and short-term obligations. So it poses some difficulty in actually matching the asset side and the liability side. And also, it's not easy to do sound risk management if you operate in different jurisdictions and if you touch on a lot of line of businesses. So that's the story for Ambon. So if you have any questions, you can put your queries in the chat box. Thanks. Yeah, Rent, over to you.
All right, thanks. So now we've shown you aggressive growth in different countries with Gefion, corruption and fraud in China, and I'm seeing CBL, aggressive growth and reinsurance with CBL Insurance. Merced is just different, and it's different in a couple of ways. Oops, I'm doing my own slides and I went too far. All right, they're boring. They were established in 1906 as a mutual company. They lasted over 100 years, selling personal, property, auto, machine, and farm insurance, primarily in the Central Valley of California. And the company over that 100 years, when its success mirrored the valley. And when the valley did really well, the company did well. When in the 2000s, there's been the 2010s and 2000s and 2010s, the growth in the Central California Valley, they was having a hard time, and the company had harder times. Homeowners insurance accounts for about 2/3 of the business and number of policies and 80% of the money. So one of the important differences between Merced and the other companies that we talked about already was that this was a good insurer at taking risks. Their underwriting expense, their loss ratio for the 5-year period before they went under was 32.6%. They knew the market, they knew who to insure, they had a solid business. If the board identified a problem, I'm going to go to the next slide, it was that their expense ratio was too high. They didn't have the scale they needed in order to operate their business. So their loss ratio was incredibly low. Their expense ratio was really high. And the company actually, they sold and they joined an insurance group, Heritage Financial Group, in 2006. and Heritage Insurance Group tried to help them solve the problem and grow. So in the year before the 2016-17, they grew by 30%. The problem was it was all in the Valley of California. And then in November 2018, there was a massive wildfire. The Camp wildfire caused, this is the fire caused by the hydro company in California. One of the wires was hit by lightning, sparked, and caused a wildfire. November 8th, it burned to the 25th, scorched more than 150,000 acres, killed 86. I've seen others slightly higher. People died, 19,000 buildings approximately, and $17 billion in total insurance claims. The problem for Merced is it was directly in the California Valley. Everything they insured was destroyed by that fire. So the company had a capital base of 23 million. They purchased reinsurance. They were relatively well regulated by the state of California. It's a completely modern regulatory system. They had to do all of their earthquake filings. They had to do all of their reinsurance reporting. The company took their risk seriously, but the concentration risk for this company in California was just, no one ever envisioned that everything would go down. In particular, they were really big in Paradise, California, a city of 40,000 people. The entire city burnt to the ground, most of it. And Merced, at the end of that fire, estimated that they had $87 million in liabilities for their $23 million in capital. Within 2.5 weeks, the company went from a profitable, growing insurance company that was trying to grow its way out of its problems to handing the keys to the California Guarantee Insurance Association. The cause of failure actually, in retrospect, they weren't as good as underwriting as they thought, because all of their risks were concentrated both geographically and by line of business. They got insured the wrong things at the wrong time. There's a combination of bad luck. And the reason this is different than the others is that at PACICC, we have gone through every insurer that has left Canada since 1980 and every insurance failure since 1960. And of all of those, we can only identify 2 for sure. In the 1960s, 2 insurance companies in the prairies went bankrupt due to natural disasters. But everywhere else, natural disasters has not caused failures in Canada, and it has not caused failures in most of the other modern insurance marketplaces across the world. And insurers are good at this. You're really good. See, the company does their underwriting, they go to the reinsurance market, the reinsurers do another evaluation of geographic risk and concentration risk, and it's managed properly within the system. Merced got nailed by this huge fire in exactly the place where they insured everything. And this is an example of how climate change makes the business of insurance even more risky. In retrospect, the fire season in California is longer than it used to be. The risk of fire and the drought in the California Valley, in retrospect, it's not hard to see why there was a massive wildfire in the Central Valley of California. However, this company lasted 100 years managing that risk. They knew the market, they knew who they were insuring, and they got overrun by claims. So some of the lessons learned from Merced. Number one is geographic concentration of risk. This is a small company that was not able to spread itself geographically. They were over-concentrated, selling one kind of insurance to one place, and everything burned down at once. Two, climate change mattered here a lot. And this is the first time that we are aware of at PACICC where climate change specifically took down and was the primary cause of a wildfire. There's a link between the wildfire and climate. There's a definite link between that fire and the decline of Merced. This is something that we are talking with our compatriots in the International Forum of Insurance Guarantee Schemes. And this one, for all of us, is different because this is the first time we've been able to see that link directly. And through it's called IFIGs, the International Forum of Insurance Guarantee Schemes, we've actually created a case study for insurance regulators across the world based on Merced and how the link between concentration, small company, the wrong place, the wrong time, and solvency is absolutely real. Second, the company was not diversified. They were too small, wrong place, wrong time. Okay, that brings us to my conclusions that I'm going to try and bring home a couple of things here. Number one, the number one conclusion that PACICC makes to regulators and to the companies in this room is that despite business where we're operating and all of the proof and improvements we've seen in the regulatory system, particularly in Canada, P&C insurers can still fail in a modern regulatory marketplace. Denmark has Solvency II. They are a modern, well-run insurance marketplace. They're well-regulated. All of the markets that Gefion participated in are also modern, well-regulated insurance marketplaces. The company failed. Two, the common causes of failure, the stories that you heard today, there's a definite common thread in them all. The names change, the emphasis on certain points may change, but the script remains the same. And when we look at companies, and I talk to regulators about solvency risk, new companies are more risky than established companies, generally. Gefion was new, CBL was new, or CBL had huge changes in the organization, and Angbang was new. Those new companies need to establish relationships. New companies are more prone to fail than older companies. Two, huge growth. Any company that is growing like 30% a year is generally it's too much change in the company. And that's one of the warning signs. Huge swings into new markets and new products where they don't know exactly where the risks are. They can't properly assess or pick the risks. And in particular, who binds that risk on behalf of the insurance companies causes huge problems throughout the structure of the company. Three, organizational structure. And if you can't describe it and you can't measure it, then how can they regulate it? And how can we ensure that it is staying solvent? And in particular, the huge financial conglomerates like Angbang and CBL and even Gefion. One of the core issues is that the different parts of the company didn't report to the whole through the organizational structure, and they certainly did not report through the financial structure of the company. And the board of those enterprises had no idea what was going on at the operating level of any of their subsidiaries. In particular, going forward, the financial conglomerate structure, in my opinion at PACICC, is going to continue, the increase there is going to increase in Canada and abroad because of the accounting rules of IFRS 17. And it's going to be really hard for even an insurance professional to fully understand how your business is doing let alone reporting to a board. And if each parts of the company are making different assumptions, the conglomerate or the consolidated statements are going to be incredibly hard to figure out. The third part is climate change is new and real, and it's not new, but it is real, and we have our first documented case of climate change directly linked to solvency risk, and that in part explains what's going on at OSFI and their approach to climate risk and the aggressive tone they've taken. But that is continuing going forward, and that wasn't on our list of warning signs before. But now in Canada, there are smaller companies, local businesses, members of PACICC, who are exposed in a way that even if they're good underwriters, they still have significant solvency risk. The last part, the cause of failure is never unique to a company. In-bank, potentially, there might be some parts of that one that's kind of unique. But if you have a company that grows too fast, that reaches into markets it doesn't understand, that a lot of times there's a CEO who is a strong presence that bullies the board of directors and gets his own way, that universal model leads to failure. So I want to close with, sometimes we are asked by insurers and by regulators, we tell these stories and we get, I don't think that could happen here because Canada is so well run and it hasn't happened. There hasn't been a failure since 2003. Well, at PACICC, we believe that there are 4 potential types of insurance failure within our membership. The first one is a traditional poor insurer model. And I'm not talking about any of you specifically, but there are insurers who are experiencing, even in the last 2 years, of the most profitable time in the insurance industry's history, didn't post profits. Those companies are the ones we worry about. That risk is real. 2, you have the multi-jurisdictional either branches in Canada where the failure of a branch could be imported from the problems of the parent, and the parent goes under in another jurisdiction and the branch goes down. Conversely, you can have the mirror where you have a Canadian company operating in multiple jurisdictions and you have problems in those other jurisdictions that takes the Canadian parent down. All 3 of those are real. All 3 of those, in my opinion, PACICC is ready for. The regulatory system will work. That's what most of the system was designed to do. The 4th one has to do with the overconcentration, failure by a natural disaster, where you have a profitable or reasonably profitable company that fails in 2 weeks. That one, PACICC could handle, and I'm going to go back to, we have estimated, and we are on the record of saying that the insurance industry does a really good job of managing catastrophic risk. And I think I've presented to this group before our estimate of how big a natural disaster could the Canadian insurance industry handle. And the answer to that is about 25 to 30 billion. The system will work fine. Between 25 and 30, the system will work not fine. It will be messy. We'll be in the news. Companies will fail. It's not going to be easy. Above 35 billion, the industry is not designed for that. That punishes the limits of pushes the limits of the capacity of any private industry. There is a capacity limit to Canada's insurance industry, and we made that case to government officials, to Department of Finance with regard to earthquake risk, and we will continue to. The difference between that 35 billion earthquake backstop discussion and the failure of a single small insurer is that the PACICC model is designed with our claim limits for a normal claim loss development curve. When there's a massive catastrophic loss, that claims development curve will be different. You're going to have hundreds of people who have total loss claims, and PACICC is not designed for that. The system won't work as we envisioned to be in that case. And there are some things that PACICC would need to change, and insurers will need to help us change in order to make the system work in the case of that catastrophic driven failure. There could be hundreds of claims that exceed the PACICC limits, and every single one of them are going to go in the newspaper. Every single one of them is going to be going into their MPP or MLA or member of National Assembly's office complaining about the insurance industry. And that is the problem that PACICC is designed to not to deal with. There are some things that PACICC would need to adjust in order to deal with that last cause of failure.
There's a couple of, Grant, if I could just say that in the chat, there's a couple of really good questions that have been put forward, and also Danica had her hand up as well, just to.
Sorry, I can't see those.
Yeah, I was just trying to flag that there's questions in the chat, and I didn't know if you wanted me to read them out.
Sure, go for it.
Okay, so the first question is from Sharon, and Judy and Alistair have been adding to the chat some comments on that one. This is a question about Merced and the fire. Could the same be said of the Texas winter storm last year? Are there other examples?
The answer to that is yes. There are examples in Canada. Wherever you have a small company geographically concentrated and you have a loss that violates the law of the core principles of insurance, it doesn't happen everyone at the same time. The risk can't be diversified. Yes, it can happen. And Merced is an example of a good example of a problem that does exist.
All right, so the second question is from Jeff. Did your research into Merced identify any lessons learned related to their reinsurance catastrophe program, e.g., purchased cat coverage to 500-year MPL, but Camp Fire event was 1,000-year event? Thanks.
The answer to that again is yes. So they were part of a modern, well-regulated insurance marketplace. They have the regulator there understands earthquake risk. They have professional advice and reinsurance brokers. They bought significant reinsurance for the size of their company. They had $23 billion of capital. They brought in another $17 billion in reinsurance, which is more than 2/3 of their entire capital base in contingent reinsurance capital, and it wasn't enough. So yes, there are examples. It didn't save them. They used reinsurance, and the answer was they didn't get enough.
If I might, Ian, to this critical point, I think the practical issue that's being raised by climate risk and Nat Cat type events that are kind of outside model is that when we think of a traditional DCAD or the FCT stress testing that all of our organizations would do as a matter of course and best practice, I think there is a very practical question now about the way that we do stress testing and whether we shouldn't be modeling how big would it be for each of our organizations? What would have to happen for us to reach the tipping point as an organization? How big would the big be? And really understand what your exposure is to the unmodeled event or the improperly, inaccurately modeled event. And I think each organization really needs to be thinking about, are they stress testing severely enough in a world where Mother Nature is now producing events that are beyond our historical expectation, both in frequency and in severity. And so it's that kind of combination of the things that's making Us at PACICC worry that we are not stress testing our organizations enough, and that regionally concentrated organizations in particular have got to be thinking more deeply and comprehensively about their exposure and their aggregated exposure to particularly severe climate-fueled natural events.
Agree 100%, Alistair. As an example, everyone who operates in British Columbia, Quebec, or Ontario, every insurer in Canada files the B9 guideline. The B9 guidelines asks, can you have the financial resources for this size of an earthquake? That is, and we're 500-year earthquake. That's a different question than how big an earthquake are you ready for, or how big a wildfire are you ready for? And that sometimes produces answers that are uncomfortable. The reinsurance brokers and the reinsurers and the company all modeled in this case. The models were wrong and the company went under.
Are there other questions or comments out there? Those are good questions. Thank you for those. I got to tell you, you're making me feel so self-conscious, Grant, that I lived long enough. I'm 61. I lived long enough to have a hurricane named after me. And now you make me feel bad, all this talk about natural disasters. So terrible. Anyway, okay, I want to thank our panelists, my colleagues, Judy and Grant, for being part of this broadcast. And there is contact information if the email addresses, which are pretty formulaic, first letter, last name at pacic.ca. And do drop a line if you have any questions or if anything comes to mind after this broadcast. We'd certainly love to circle back with you on that. While I've got you on the line, let's look ahead. Our final event, you're going to get a registration package very shortly. Our November 16th Risk Officers Forum meeting. These are the subject matters, or these are the topics for discussion. The keynote is going to be focusing on our strategic planning conference, which took place on June 9th. And we're going to have board chair Glenn Gibson and Alistair Campbell, president and CEO of PACICC. They're going to be in a fireside chat about how this is going, the implications of the proceedings from that strat planning conference on the strat plan for PACICC for the years 2023 to 2025 and beyond. So it's immediately affected our next 3-year plan. And you'll hear all about that, which is quite interesting. And another topical point of conversation, class action lawsuits for business interruption related to COVID-19. So we have 2 parties on this. Sarah Armstrong is Chair, Ontario Litigation and Dispute Resolution with FASCN. And we have our own Bernard McNulty, Chief Agent for Canada and Head of Claims Canada. He was on the line today out there from Allianz Global Corporate and Specialty. So those 2 are going to talk about class action, the status of class actions. And finally, we have a 3-party panel, increasing compliance risk from changes to privacy legislation. Molly Reynolds, a partner with Torys LLP, and their lead for the privacy group is going to be part of the broadcast. Jessica Seppi, Senior Vice President, Chief Counsel, and Chief Compliance Officer with Liberty Mutual Insurance Company is going to be part of the broadcast, as well as Lauren Groen, Legal Counsel and Compliance Manager for HDI Global Specialty SE Canada. And Lauren was on our broadcast as an attendee today. So certainly hope that you can be part of that broadcast, part of that event next month. You're going to get the registration packages shortly. There is going to be a follow-up satisfaction survey. We always do that. We want to hear your questions and your comments, ideas for topics, discussion topics as we start a new year, and speakers. I want to thank you for joining the broadcast today. We hope to see you on November 16th. Enjoy the rest of your day, and goodbye for now. Thank you.